Welcome back to another edition of The Road to Financial Independence. I'm Mike Riskin, the president of CPS Investment Advisors, and I'm here with my partner, Peter Galacco, CEO of CPS. Hey, Pete.
Hey, Mike, how you doing?
As always, I'm doing well.
Doing well.
Thank you.
Not a broken record today. I love this section, but it's not my favorite.
Not your favorite.
Not my favorite because it's a little bit difficult to explain and discuss.
Sure, and I think we do a great job of it. So hopefully the audience will love today's topic, and it's continuing as our part of our educational series. And part two, hopefully everyone had a chance to see part one of the Achieving Financial Independence. And today will be part two, where we really do a little bit of a deeper dive into the investments and investment philosophy, I should say.
Correct.
We're not really going to make any investment recommendations or specific things like that, but certainly philosophy and a little bit more into the inside of how we think. And I think a great place to start is really just a broad, general topic discussion of risk tolerance and the risk spectrum. So kind of, what is out there in the world of stocks, bonds, and cash where I can invest my money?
Well, what I want to touch on first is the types of investments that are out there that are available. And there's really only three types: stocks, bonds, and cash.
Right.
Okay. And all of them come with, there's only three, but if you look at stocks, you got small cap, mid cap, international.
Right, there's a lot of different tiers inside that.
Large cap. Yeah. There's, dividend paying, non-dividend paying, NASDAQ, Dow stocks, a lot of different tiers. When it comes to bonds, you got corporate bonds, you got government bonds. There's a lot of different types of bonds you can buy. And cash is money market. There's a lot of different returns on money markets than just straight cash. So there's a lot of options out there. But when you're looking to invest your money, you need to look at risk more than anything.
Sure.
Because some investments come with a higher risk than others. So if you take a look on the risk spectrum, the lowest risk is cash. You get an interest rate. Normally your money market funds will trade at $1. So they're fairly secure. So you're not putting a lot of risk in your portfolio, but in return, you don't get a lot of return.
Right. And that would include like CDs also.
Correct. Cash and cash equivalents.
Okay.
When we go to bonds are a little bit more risky, and they offer a little bit more return than cash. They're not as risky as stocks are.
Right.
And they normally don't go up and down in price that much. And the way bonds normally work is when you buy a bond, you're going to buy a bond either at par, which is 100, or you're going to buy it at a premium, which is above 100, or a discount below 100. So when you're buying bonds, you're trying to buy it at a discount, and then you get a return. And then when the bond matures, you get all the money back. You get par, so you get 100. Now, there's some bonds where you might want to buy it at a premium because it's selling at a premium, but the rate of return is so good it makes up the difference.
You have to look at the total.
Correct. But when you're looking at that, when a bond matures at par, there's not a lot of risk there. The only risk you really have is the company that is putting the bond out that goes out of business.
Because a bond is a company issues debt.
Correct.
And you're buying the debt and they're paying you back.
Correct.
You're basically,
and you can get hurt a little bit with, interest rate risk. Let's say that you bought a bond that's paying 3%, and all of a sudden you can buy bonds at 5%. Well, you're going to have to hold that bond at 3% for a long time.
Your bond's not going to be worth very much. Yeah.
Correct. But you're going to get 100 you're going to get
if you just hang on to it, you get the value of the bond back.
But the interest rate risk is you're not able to parlay that money up to a higher rate bond. You can later on after it matures, but that's where you run into some interest rate risk, which isn't a huge deal. But
it's there.
It's there. It could cost you a little bit of money.
Of course, the reverse is true also. If we're in a high interest rate environment and rates go down,
correct,
then all of a sudden your bond's looking sweet.
Everybody wants your bond. That's when you pay premiums for those things. So if you have a 6% interest rate bond and all of a sudden now the bond rates are 3%, everybody's going to want that 6%.
Yeah, you're not selling that sucker.
Correct. Or unless you get a really good premium for it. So so there's ways to make money, and there's not a lot of risk there. Where you're going to run into the risk is when you start buying stocks, okay? And a lot of people think, the S&P 500 and all that. What I'm talking about is the pieces of all those indexes and all those mutual funds, the actual stock that makes it up, okay? So, on the stock side, the least risky stocks are going to be your big, large cap, blue chip, big dividend paying stocks that have been around 100 years. The ones that, they don't go down as much when the market goes down, but they do good on upswings. the blue chip dividend payers usually have the least amount of risk when you walk into the stock side. Then you got the large stocks, the ones that don't pay a dividend, but are part of the large corporate stocks. And as you go up, you get an international and small cap. And why is international and small cap a lot more risky than your large cap stocks here in the U.S. is because the U.S. has the largest economy out there.
Largest capital markets out there.
And if you're going to go international, you got to be really careful on what you buy and where you buy. You don't want to be buying in China because they could rip the carpet out from underneath you. Those are drastic examples. But you also could be going into emerging markets where they don't have the earnings to continue to pay what they're to pay out what they are.
And they're just so people have made lots of money over time in international, in emerging markets,
Correct.
in small stocks, but understand the point here is understand the risk you're taking, because while you might be up 50% when you could just as easily be down 70% the next year.
Correct. And if you take a look at the past 100 years, past 50 years, small cap stocks have done better.
As an annualized average return. Right.
But if you take a look at the roller coaster ride, hold on to your hat.
Right.
It was brutal. And not a lot of people can handle that volatility. There was a study that said that people's emotional state on the market going up is a lot less than your emotional state on the market going down.
Right.
They're a lot more emotional. They're looking at it. And, I wish it was the other way around, because the way people build wealth is they buy stuff that's on sale.
Right.
So, when markets go up and down, a lot of people are not making the wealthy choice. But if you're looking at risk alone, you got to stay within the right risk parameters. You could have a little bit of small cap, you could have a little bit of international, but your main core of your investment should be your large company stocks.
And one of the keys, I think we addressed this in part one of the podcast, was to keep people invested.
Yep.
And if we remember, we talked about staying invested at 10 years, market goes down, people want to get out. Well, if in year 3 and 4, you're losing 70%. There's a good reason why you may want to get out. You're more in the gambling range, versus if you're owning solid companies, big companies that maybe don't lose quite as much. It's a lot easier to get, say, hell, the market's down, let me put more money into the market, versus getting scared and running away.
A lot of people don't realize this, but if you go back to 2008, I'm dating myself. 2008, when everything fell apart, every company's stock price went down. There were a lot of great companies that made more money during 2008 and 2000. Their earnings didn't go down.
That's right.
But their stock price went down. And people want to sell their stock for 50 cents on the dollar, when all you had to do is close your eyes for a little bit and the market recovered. It went from 6,500 to 44,000. So, making changes in the short term, because short-term feelings isn't really what you should be doing. If you got a good, solid investment philosophy, hang in on those downturns. Put a little bit more money and buy stuff on sale.
Yeah, and one of the concepts that we hear a lot is this diversified portfolio. So you just hit on about 5, 6, 7 different types of investments, from the cash all the way up to the small cap stocks. Talk about, what does it mean to be diversified, and how does that, why shouldn't I just get, if I see a sector made 40% last year, why would I not just want to ride the wave of that, Pete?
That usually doesn't work. And there's an old saying that said, don't put all your eggs in one basket. And because if you drop that basket and your eggs break, you don't have any eggs. So with a diversified portfolio, what it means is you're taking your funds and you're diversifying it amongst multiple asset classes and multiple stocks. Okay. But the asset class, the diversification is going to look like about 95% of your return. The other stuff is what you pick and when you pick it. Diversification is what keeps your portfolio growing for you.
Right.
Because not every asset class makes money from year to year. Now, I say you should take a look at your large cap investments, your large company stocks, because they're the safest ones out there. But if you take a look at the year over year, they don't win every year.
That's right. Yeah, and if we look at this chart, you can see that the color scheme is all over the place, in terms of the top of the chart being that year's winners and the bottom of the chart being that year's losers.
That's correct. And that's the dark blue, And if you take a look at the dark blue, the roller coaster ride you went over throughout the years, I'm sorry, it's a light blue.
The light blue is
throughout the years. Actually, from 2003 to 2024, there's only been what 1, 2, 3, 4, 5 years that the blue outperformed. But you see, you got international stocks, you got long-term government bonds outperforming. So what we want to do is we want to have a blend of all of those asset classes.
Yeah, because there's one, when I look at this chart, there's 6 bars here, and there seems to be one dark blue color that's kind of in the middle the whole way along.
And what we want to do with your investments is we want to make sure that they're not swinging wildly up and down. Now, everybody loves when the investments swing up, but when they swing up a lot, that means they're going to swing down a lot. It usually happens that way. What we want to do is get good, decent returns when the stocks are down. We want the portfolio growing. Your bonds should do better there.
Right.
When bonds and stocks, U.S. stocks are down, international does better. So we want to make sure that, every year after year, we've got asset classes growing for you,
right?
Because we can't control when things go down.
Right.
But if you take a look over history, if you got a balanced portfolio, you're going to beat any other asset allocation.
Right. And along that theme, a lot of folks want to just outpace the market on the, when the markets are going up, pretty much anyone can make money, and you just want to go. But one of the things we've learned over time, and the research supports this, is explain the concept that if you lose less on the down market, you're going to outpace in the long run. Yeah. And we kind of explain that concept a little bit, because that's so key in long-term returns.
So if you can imagine this, you got 4 pieces of paper, and that equates to your portfolio.
That's 100% of your portfolio.
100% of your portfolio. And the market, like 2008, went down about 50%. You take away 2 of those, so you have 2 left. Now, if the market goes back up 50%, 50% of 2 is only 1. You got to double your money in a down market to get back to 0. That's why making the most in an up market isn't the most important thing. Because if you're doing that, chances are you're going to lose the most in the downturn. Markets work like that. So if my clients in that 4 pieces of paper, they're in the market and they're not aggressive, they've got a conservative portfolio, and it goes down 25% rather than 50, and it goes back up 50, guess what? They're making money long before anybody else.
Yeah, they've got more than they started with.
They got more than they started with before the market went down.
That's right.
And that works. It mathematically, and we've seen it happen in the markets. That's why, not taking a lot of risk. I mean, you can take a lot of risk, but you don't have to.
Right.
Everybody wants to get that next Apple computer out there. And that's not a recommendation buy or sell, by the way. But, if you bought Apple at $2 a share, you're a wealthy person. But let me tell you, nobody wanted Apple at $2 a share.
Right.
I mean, it wasn't until the iPhone came out that they started to really crank. And that wasn't, in a whole scheme of things, that wasn't long ago.
Yeah.
So finding that next Apple you're going to strike out more than you're going to hit home runs. What you want to do is hit baseball here. You want to hit doubles and singles and win the game. So hitting doubles and singles is buying a great company, getting their dividend, reinvesting that dividend, and when the market goes down, putting more money into that great company. And understanding that, if you buy the right things, you don't have to worry about recessions. You don't have to worry about, the economy.
Big market corrections.
The economy closing down in 2020. There were a lot of great companies that made money during that time because their doors stayed open. Right. So, I heard when I first started my career, I heard from a really, really old gentleman, very wise. He told me that if you invest your money where you have to spend your money, you'll do just fine. I'm like, well, that's interesting. Have to spend my money. He goes, yeah, you have to pay your electric bill, electric utility. You got to put gas in your car. Guess what? Gas companies are good. So way back when, it was very easy to look at, a little bit more difficult now because we're more in a computer. There's more technology out there. You got to pick that. But if you're spending your money, and if you're buying an iPhone, if you have an iPhone, I always ask people, if you drop that iPhone and break it, are you going to go and buy a $1,000 iPhone again? Or are you going to go and buy a generic brand? Most people say, I'm going to go buy an iPhone.
Right, they'll buy what they already have.
What happens if the iPhone's $1,040? Well, I'm still going to buy the iPhone.
Right.
So, we look at comfort, we look at ease of doing stuff. It's convenience now, and, things like that are durable. So, when you look at investing your money, you want to make sure that you're putting it in the right industries, but you're not looking at hitting home runs. We don't know who the next one is.
Right. And I think one of the, it's a great thing that the stock market typically does go up, and statistically it's up 7 out of 10 years on those types of things. But we have to remember that it is down 3 out of 10,
Right.
and even small little correction or small big corrections or short window big corrections. And so those are the key moments where that'll really show, the quality of your portfolio. And again, going back to that example, if you take a huge hit and you have to start over again, or you buy something that goes to zero, I mean, you're starting over, and
It doesn't feel good.
so horrible to try to restart that. Right.
So, make sure that you invest your money properly so you're not taking those huge hits. And when people take huge hits, they do the wrong thing.
They do. And there's so many people are afraid of the markets because, there's really two types of ways to approach the markets. There's investors and there's traders. And so that minute to minute, day to day, up and down, people that really talk about the casino of the stock market and gambling, that's really the day to day, minute to minute, getting in and out. That's not really investing.
No, and that doesn't work.
Right.
If it worked, they'd put us all out of business.
That's right.
That doesn't work. It may work in short periods of time, and those people are chasing winners. What the people that build wealth are looking for things on sale.
Right.
Yeah,
long-term investors.
Long-term investors. Hey, we had a little bit downturn in this market. Let's go and buy some of these great companies that are kind of trading at a little lower price. And when it recovers, you got more recovering,
right,
and you got more sending you a dividend. There's a lot of real big reasons to do these kind of things.
Right. So let's dive into the philosophy a little bit in terms of talk about earnings, and we talk about dividends. And we'll let's go over a couple of companies that and this is absolutely not a recommendation to buy or sell. This is just purely an example, education and to kind of back up our philosophy and how we're thinking. So let's start with Johnson & Johnson. I think this is a company most of us are familiar with, and we use a independent research group called Value Line that helps provide some data points for us. So that's what you're seeing on the screen right now. Pete, walk us through one of these value lines and some things that we look at, and maybe if you're looking at it on your own, some things that you should look at.
Well, first of all, I want to talk why we're looking at Johnson & Johnson and not the S&P 500 index or the Vanguard Growth and Income Fund or something like that. The reason why we're talking about individual stocks is if you're wanting to build wealth, this is the right way to build wealth. How many people, Mike, do you know that made their millions buying a mutual fund? The reason why mutual funds, that people underperform in mutual funds is because it's very emotional. They'll buy the mutual fund when it's doing well, but the minute the market turns around, they're selling.
Right. There's very little attachment to that.
Very little buy-in to what they actually own because they don't know what they own.
They don't know what they own.
This or Fidelity that or a Schwab this. But in reality, those funds are made up of individual stocks. Why, if you know what you want, you know how to build your wealth, why not go buy an individual stock? You don't need all 500 of the largest stocks. You may only need about 30 of them, 30 of the best ones out there. So the reason why we talk about individual stocks is that's something that we recommend as a piece to build wealth because, of course, we can control a lot of things. We can control capital gains, which is one of the largest expenses out there is your taxes. Right. So we can control capital gains. We can control exactly what's in your portfolio and what weight it is. Also, sectors. We can add weight to sectors that are doing well, take weight away from sectors, and mutual funds don't allow us to do that. And people that have bought stocks in the past, Walmart, Coca-Cola, Home Depot. You got millionaires out there who just buy this stuff, who just buy these stocks, hold it, take the dividends that come in and buy more.
Right.
Go buy more. Go buy a great company. And that's how you build wealth. And when the market goes down, they don't sell.
Right. They buy more.
They buy more. And the reason why they don't sell is because they understand what they own.
Right.
All right. So we're gonna talk a little bit about stocks and really, can you understand this? And is this something that you would be comfortable buying? Not this stock, but this type of stocks. And there's a lot of them in the market like this. Not all of them, but there's a lot like this. So the first one is Johnson & Johnson. All right. So I'm going to talk a little bit about their financials. Their company strength is A++, the best company strength you can get out there. It's A++, earnings predictability, which means we can go out 5 years and predict their earnings 95% of the time. It's a very, very boring company. You're not going to lose any sleep over Johnson & Johnson. But what does Johnson & Johnson do? They're a pharmaceutical company. Now, during downturns in the market, do people stop taking their pharmaceuticals? No. So this is really a durable product company. Regardless of what's happening in the economy, people continue taking their
Yeah,
pharmaceuticals.
plus all the first aid stuff that they provide. Yeah.
Absolutely. If you cut your finger, you're going to go to the store and buy a Band-Aid. Even though we're in a bad recession, you're still going to use their services. It's a type of company we call durable. It means that doesn't matter what economy we're in, they're still going to do well. And if you take a look at Johnson & Johnson on this chart, I'm going to go down to 2008 at the bottom. 2008 was when everything was falling apart. 2009 wasn't good. 2010 struggled. But if you take a look at their earnings per share, which is the second line up, in 2008 is $4.57, $4.63, $4.76, $5, $5.10, $5.52. Does that look like a company in trouble?
Right, they're making more money even though we're in a great financial recession.
And they raised their dividend from $1.80 to $1.93 to $2.11, $2.25. Now, dividends are one of the most important things to know when you're investing.
I think that's an important topic we need to talk about.
Right. 40% of the return on the S&P 500 comes from dividends alone. If you don't have dividend-paying companies, you're going to underperform. You will. Long term. You might overperform in the short term, but long term, you're not going to overperform because dividends come in the portfolio. You buy more stock with it. And buying more stock with those dividends increases your dividends that you buy more stock with later on. So more shares means more income. More income means you buy more shares. And if you don't have a stock that does that, you're not buying any more shares.
Right.
In 10 years, you'll have 1,500 shares like you started 10 years ago.
You're just purely relying on the price of
Purely relying on appreciation, what the market does. And I don't like to do that. I like to make money in a lot of different ways.
This is the money while you sleep at night.
Absolutely. Johnson & Johnson's ranked one for safety from Value Line, which is an independent rating company. And Value Line started on July 27th of 1990. And Johnson & Johnson's had the safety ranking of one ever since. Yeah. Very few companies get the safety ranking of one from Value Line. Mm-hmm. Very safe, great company, and it's on sale. Not saying you should buy it. No, not saying buy or sell, but you can see that it's on sale right now.
And go back to the dividend for a second. And you mentioned the growth rate. Look, in 2008, it's showing $1.80 per share.
Yep.
And in 2024 or 2025, it's at $5.20. So you're telling me that I'm getting paid almost 400% more than I was 15 years ago.
And take a look at this. It's paying $5 a share, $5.20 a share at 2025. If you go back to 2015, it was paying $3. Your income's going up every year.
Yeah.
And the nice thing about it is it's not like going to work, you have to ask your employer for a raise. These increase regardless of what you ask, and they go up every single year.
Yeah, I'd like maybe we can discuss a 300% increase every 10, 15 years.
That would be good, wouldn't it? That would be good. But if you're investing for the long term, one thing you want to do is you want to avoid investing in stuff that you got to watch every day,
right?
Because you're going to miss. You may make the decision to sell it right one time, but you're going to miss on the way up because you're not going to be able to make the right decision twice. So these are the kind of stocks that you could hold for the rest of your life. You wouldn't have to sell it.
And I think one more just to, I know we're kind of pressed up against time in this segment, but another one that we've researched in the past, again, not a recommendation to buy or sell, but McDonald's sort of fits our philosophy very well in terms of those numbers.
And people don't really understand what McDonald's does.
That's right.
They go, oh yeah, our kids eat there. You may not like their food, but it's a really good run company. McDonald's is a real estate company. Right. McDonald's is a corporation. Do not flip any hamburgers. All right. What they do is they provide real estate. They provide the dirt. The operators build the building, do the business, buy all the supplies, and then pay McDonald's rent and a royalty on running the business. Now, if that operator doesn't perform, McDonald's removes that operator and puts somebody else in their building and starts all over again. It's really neat business model. And they actually have to tear down the building so often and rebuild.
That's right.
Yeah. So, and then McDonald's loans them the money and gets it. So it's actually, as a real estate company, it's a really good real estate
win-win.
company. It's a win-win. And looking at the financials, company strength A++, 85 earnings predictability. We can go back 5 years and predict earnings 85% of the time. Safety of one. Again, this is another company that's been safety of one since day one. If you take a look, I like to look at, how it's performed earnings per share in the past 10 years. Have we doubled? Have we doubled in dividends the past 10 years? And really where we look at there. So I'm looking at $13 a share in 2025. So that would have been $7.50 in 2015. It was actually $4.97.
Wow. So it's,
all right.
Yeah,
So-
it's well more than doubled.
Well, more than doubled. So we got
I don't know if that's proper English, but-
643 in 2025 on the dividend,
Yeah.
or 743. And if we go back to 2015, we're looking at 347.
Definitely more than doubled. Yeah.
More than doubled. So your income's doubling every 10 years.
Wow.
The earnings in the company's doubling every 10 years. And when you invest your money, you want to invest in something that's going to be there and that's going to be
Right.
good for you for the rest of your life.
So no matter what shenanigans are going on in the markets, in the economy, in Washington, D.C., globally, and if I owned a company like this, I sat back and closed my eyes, and 10 years later, I'm making at least twice as much money as I was making.
Absolutely. And the dividends you took and reinvested it back. So now you got twice as many
Right.
shares. They're creating twice as much income.
Wow.
So
What a concept.
It's a bad problem to have, but you don't have to be scared to do this if you're buying the right stuff. And it's not hard to find that.
Right.
What you got to do is turn off what all these great tips everybody's telling you. That stuff doesn't work long
Right.
term. This is what works. This is what gets you to financial independence.
Yep. And then one of the other reasons why people are so scared of the market is it seems like every year, no matter what the market does, there's always a reason.
Always a reason.
Not to buy stocks.
And I think there was only one year there was no reason. I think it was 2016, was it? One of those years that let's see. No, it was 2000.
Oh, it was 2006. Yeah,
not
yeah.
a bad year. Pluto was demoted from planet status.
Let me tell you, that was a pretty demoralizing year for me.
Yeah. But I mean, we had the tech bubble in 2000, September 11, .com bubble, war on terror. In 2016, we had the U.S. election.
Right.
Now every election is a big blow up in, emotions and all that. So
There's always going to be a headline maker telling us why we shouldn't buy. I love going back to some of these old magazine headlines where, death of the stock market and end of U.S. equities. And you think like, oh, that's from 2020. And no, it's like from 1956, right?
That's right.
It just keeps repeating itself over and over.
It's never different. And if I could give you a little bit of my 35 years of wisdom doing this, don't listen to any of that stuff. Don't listen to any of it. You can't control it. They don't control our markets. Our political system doesn't control our markets. We do. It's how we spend our money. What they do is try to scare us into not spending it and create problems. But as long as we live our life, go out to eat. If the restaurants are full, the economy's doing well. If you're flying, if the airlines are full, the economy's doing well. Just do those two things, and you'll be able to see when things start to change.
That's right. And tune into our YouTube channel or anywhere else where you get your podcast for other additional educational content. We've got a lot of things rolling out here in 2025. Thanks again for watching. And if you'd like to contact us, feel free at info@cpsinvest.com, as well as 863-688-1725. And look forward to doing this again soon. Thanks again. Bye.